Friday afternoon, everyone. This is Phil Pearlman. I'm joined today with JC Parets, Eagle Bay All-Star Charts, El Hombre de los Hombres. JC, what's up, man?
I'm good, Phil. I have no idea what that even means, though, but I'll take your word for it.
You are the man of men, my friend.
God.
Is that Spanish? I might have been Portuguese on you. I might have dropped some Portuguese. I think it was Spanish. It was like a broken. What's up, buddy? So you like the Miami Heat tonight against the who they playing?
Bulls, doubles.
The Chicago Bulls.
I'm bearish Bulls tonight.
You're bearish on the bull. You're bearish Bulls. I like that. Cool. All right. So yeah, they look great again. You know they look like they're going to win it again. I hate them, but we'll get when we get there. They haven't played the mighty Knicks yet. So
The mighty Knicks. It's like an oxymoron.
so sad. Okay, so let's get to it, man. Let's start with the levels and devils, the SPX levels. What do you got for me?
It's like a stair step, right? Every time you and I have these conversations, it's okay, this was support, this is resistance. Now that resistance becomes support, and we're looking at higher levels. And it's you and I talking about the same things every week. So we were looking at that 1600. We obviously broke out last time you and I discussed this, and we kept rocking and rolling. So that's definitely a new floor. But this week, we actually had some developments around the 1623 level. That was resistance on Tuesday, then support Wednesday, yesterday, and today. So 1623 is definitely our short-term support level. We feel a lot more comfortable being long heavy above that. And the next level of resistance in our eyes is 1660, which is the measured move from that entire consolidation. So
look, this is the beauty of trend following and of riding the trend, because moves like this don't happen that often, but when they do happen, you can make a ton of money if you're in. Comment on that.
Yeah, I mean, I couldn't agree more. We've been talking about these levels. A few weeks ago, we were talking about, 1570s we wanted to hold. We held those and ripped. Then it became 1600. Now we're looking at 1623. Let's talk about a measured move real quick. Take the highs from April 11th, just around 1600, and to those lows, that key support level that we were talking about weeks ago at 1537. Let's call that 60 points. So the measured move on a breakout above 1600 should take us somewhere near 1660. So that's definitely a level that we're eyeing going forward for sure.
Okay, so let's move on. Next, this week we did have, and even this month so far, and even over the past 20 trading days, we have had a very interesting sector rotation away from some of the more defensive areas and into some of the more aggressive areas.
That's exactly right. And it's one of the things that we've been talking about, that if this market is going to keep rocking, we need to definitely see that rotation into these underperforming areas, specifically industrials, energy, tech, materials, and then out of those defensive areas that we're leading this year, healthcare, obviously, staples, and utilities. And then take the relative strength from the 15th of April. Guess who the #1 performer since mid-April has been so far, Phil? Materials.
What's that? Go ahead.
Materials.
Yeah.
Then energy.
Yeah.
And then you can make the argument that industrials after that. Guess who the worst sector since mid-April was?
Well, that I know. It's XLU.
That's right. Utilities.
And as a matter of fact, just full disclosure, I sold the rest of my XLU position today, and that's a position that I've held for over 3 years. And I sold it, retirement accounts, not trading accounts. These are investments. My children's funds that I have for them, their accounts. I sold my wife's account. I sold across the board, and it was very simply based on a break in the trend. I mean, there's no emotion there. I loved being in that trade for a long time. It was a dividend trade and a high quality trade. And my view is that that's running. And maybe I could be totally wrong, could bounce back, whatever. My guess is you get a bounce back to the trend line, and then you get further weakness. But it looks like a real break to me.
Phil, you nailed it. I remember after the Hurricane Sandy, if it was the name of the hurricane, and these Utes were getting smoked. And I remember you telling me, JC, I'm buying this dip. I'm like, you can have them, Phil, and you nailed it. Good for you.
Right on, buddy. Thanks. That was the trading. That was a trade. I mean, I watch them every day, and I've been watching. There's the dividend fund, the SDY. I'm still in that. Been in that for a long time, but I'm starting to watch that more closely, and it's just very interesting what's happening in that area right now. Like exactly what you were talking about this rotation out of the defensive and into materials and into energy. And so, from my vantage point, I see the trend break, and I'm just not hanging around.
Yeah, worst performers since mid-April, utilities. And second worst performers were healthcare, and third worst performers were staples. So we're literally witnessing that rotation, and the market is benefiting from it. We're making new highs. And the only reason, in my opinion, that that's possible is because of that rotation into those underperforming names. And if the market's going to continue higher, I think we need to continue to see that.
And so, related, and we should probably cover this today, there's this, the treasuries are getting sold, and that's part of my impetus, too, around this. I mean, dividend stocks are going to be of much less value if rates begin to climb in earnest. And very recently, we're seeing, treasuries get sold, and the dollar going bazonkers. And, you caught it sort of this end of QE trade.
Yeah, I mean, that's what we're calling it, whether we're right or not. I mean, it doesn't matter what we call it, but it is interesting, isn't it? Because in theory, if they're going to stop this QE, then that means interest rates are going higher, right? So that's bad for bonds. So they're selling bonds on that. And if they're going to stop, if interest rates are going higher, that's good for dollars. So they're buying dollars. They're selling treasury bonds. And the rest of the stock market is kind of trying to figure out how to take it, right? Because it's like a double-edged sword. So if they're going to stop with the QE, it's bad for the market because they're taking away the juice, right? But if they're gonna stop the QE, that means that the economy is probably better. So it's like a double-edged sword, and the stock market's kind of trying to figure out how to digest that, and they seem to continue to rock them, even in the face of a ripping dollar and Treasury sell-off for sure. So that's interesting, I think, this week.
And so I would be remiss. We weren't planning on speaking about this, but I'd be remiss if I didn't, especially within this context of the dollar rip and the Treasury sold, if I didn't ask you about the dollar yen.
Dollar yen, they ripped them through 100. They finally did it. I mean, I'll be the first one to tell you, I would have expected a much more of a stock market reaction to that because of that negative correlation that we've been seeing in the yen and U.S. equities. And we didn't see that dramatic of an aggressive move higher.
Does that just tell you how strong the market is? Is that just a signal of how strong the market is? Like you see the dollar getting stronger, you see the dollar yen, and the market continues to hang in there.
When the yen collapsed, I mean, they just bought dollars. I mean, that's really what it was. They bought dollars in all the currencies around the world. Aussie got crushed, Euro crushed, pounds, you name it. They were Canadian dollar. They crushed them all. So the trade was a U.S. dollar for sure. Very interesting.
So last up, I want to revisit your long Europe, short Latin America trade. Where are you on that now?
Yeah, well, I mean, we loved it last week, and I mean, went out at the highs of the week this week. So
you've been on this trade since almost the beginning of the year, right?
Well, this is actually kind of a derivative of that trade. So you're talking about the long EFA, short ILF. So
right.
Long developed nations around the world, ex North America, and short Latin America, and that
right.
went out at new 52-week highs today also. So this is kind of derivative.
Great work, dude. Great work, by the way.
Like a derivative of that. So this is just Europe and still short that Latin America. So we're still seeing that Latin American underperformance for sure. but we don't want to be outright shorted either because we are in a bull market after all. So being long of Europe, that is definitely showing some relative strength, makes sense to us, and it's working, so we'll take it.
And what are you looking for there, just for people who are following along on that, because we've talked about that, or the derivative of that trade several times over the last, since we started doing this, I think, or 6 weeks or so. What's the exit there on the risk management side? Like, what do you see there that makes you say, hey, you know what, we're going to exit that trade?
Sure, that's a great question. So let's look at FEZ specifically, which is what we're long, which is the Eurostoxx 50 ETF,
right.
And then divided by Latin American 40 index, which is ILF. And it really consolidated since last November. I mean, this is a trade that really started getting going last summer when Greece didn't go to zero and the Eurozone didn't split up. That's when Europe really started outperforming Latin America. And that peaked in December, early December, and it consolidated really for 4 or 5 solid months, and just recently broke out last week, and that's what we got excited about it. So we really just want to see that breakout hold. So let's call that ratio FEZ to ILF. Right now it's at about 0.84. As long as it really holds 0.81, 0.82, which is really that breakout level, we feel comfortable. In fact, we actually added to the position for that.
So below 0.81, that's where you would close that out.
Yeah, I think that level makes sense because that was the resistance for about 4 or 5 months, and it's a breakout play after all. So if that rolls over, then we're clearly wrong, and it's not something that we want to be in. But like I said, we went out at new highs. We added a little bit to that position. We feel comfortable with it. We like it.
Hey, JC, pleasure as always. Have a great weekend, and we'll see you next week on the stream.
Have a great weekend, Phil. Go Heat.